All right, today we are cracking open the books on one of the biggest, most powerful companies on the planet, Shell. You see, they're caught in this massive $1 trillion dilemma, a high-stakes balancing act between making unbelievable amounts of money and, the future of our planet. And like any good investigation, what they tell you, that's never the whole story. So let's dive in. So here's the central question, right? On the surface, Shell is putting on this huge show about transformation. They're talking about net zero, sustainability, this big energy transition. But the question we're investigating today is, what's really happening behind the curtain? Are we watching a company genuinely pivot to a green future? Or is this just the most sophisticated corporate performance of all time? And here is Exhibit A. This is the official story, straight from the top. The company's chairman, Sir Andrew Mackenzie, lays it out. He says the goal of net zero emissions is the very heart of their strategy. This is the green pioneer image they want us to see, the one they show to regulators and to you. But this is where our investigation really kicks off. Because when you start peeling back the layers of press releases and fancy public statements, you find the document that actually matters, the company's financial blueprint. And that document, the one that tells them where to spend every single dollar, well, it seems to be pointing in a completely different direction. Before we even get to the numbers, we have to look at where Shell's green promises were first put to the ultimate test. And it wasn't in a press conference. Nope, it was in a court of law. And this is where the story gets really juicy. So this here maps out a legal war that's been going on for years. And what's wild is how the pendulum is just swung back and forth. Back in 2021, a Dutch court drops this bombshell verdict, ordering Shell to slash its global emissions by 45%. I mean, that was a global first. But then, by late 2024, an appeals court overturns that specific order. And now, the whole thing is heading to the Supreme Court. This is far from over. It's a live battle for the future of corporate responsibility. And this right here, this shows you the core conflict perfectly. The appeals court actually agreed that yes, Shell has a duty of care for the climate. But, and this is the part that changes everything, it struck down that 45% mandate. The court basically said, look, you have a responsibility, but we can't tell you exactly how to run your business. And that single decision, it affirmed corporate freedom and handed the keys right back to Shell. So you see, that court ruling was basically a green light. It left the door wide open for Shell to call its own shots. Which means the real strategy, the one that truly matters, isn't in their sustainability reports. It's in the financial blueprint. This is where we follow the money. Clue number one is their CapEx, or capital expenditure. Through 2028, Shell is keeping its annual spending on a very tight leash, $20 to $22 billion. And the key phrase here is high return assets. This isn't them throwing cash at risky green energy experiments. No, this is a very strict budget focused on one thing, getting the biggest bang for their buck. Okay, now here's the real kicker. This number, 40 to 50%, that's the chunk of their cash flow from operations that Shell is promising to give right back to its shareholders. That is a huge figure. It's basically shouting that the number one priority is rewarding investors. And we're not just talking about small-time folks. We're talking massive pension funds and institutions that demand steady, predictable cash right now. And to make sure that cash keeps flowing to those investors, they're cutting costs. And I mean aggressively. Shell is targeting $5 to $7 billion in structural cost reductions by the end of 2028. This whole thing is about turning the company into a leaner, meaner, and ultimately much more profitable machine. So when you put all the evidence together, the picture becomes crystal clear. You've got disciplined spending, massive shareholder payouts, and deep, deep cost cutting. This isn't a planet-first strategy. It's not even a transition-first strategy. At its core, this is a shareholder-first strategy, designed from the ground up to drive efficiency and deliver some very handsome returns. Now, this financial blueprint isn't just some theory on a piece of paper, it's leading to some pretty dramatic real-world action. Shell's new battle cry is value over volume, and they are fundamentally reshaping the entire company around that idea. And some of these moves, they're both brilliant and incredibly telling. So here's the playbook. Step 1. Sell off things that don't make a ton of money, like 1,000 of their gas stations. Step 2, shut down outdated operations, like processing crude oil at their refinery in Wesseling, Germany. Now, step 3 is where it gets genius.
They convert those old sites to produce high-margin, specialized stuff, like premium lubricants. And finally, step 4, shift focus to where you can make money with brains, not brawn. Things like AI-powered energy trading.
And let's be very clear, traditional oil and gas are still the undisputed kings here. Shell is doubling down on its most profitable fossil fuel assets. These are the cash cows. They are the engines that generate the billions and billions of dollars needed to fund those huge shareholder returns and the company's pivot into these newer high-tech ventures.
So this is the really crucial thing to understand about their new strategy. Asset-light, intelligence-heavy just means owning less of the big, expensive, politically risky stuff like refineries, and instead making money from things like data, trading, software, and specialized services. It's a pivot from brawn to brains, trading physical risk for intellectual profit. It's a genius business move if your main goal is the bottom line.
Okay, so we've seen the public promises and we've peeked at the internal blueprint. We've uncovered the strategy. But what does the ultimate judge of corporate truth think? What's the final verdict from Wall Street? Well, based on the ratings from 19 analysts who follow Shell every single day, the consensus is pretty clear. The vast majority of them, they're sitting right on the fence. 11 analysts rate the stock a hold, while only 8 say buy. But here's the most telling detail. Not a single one is telling investors to sell. So what does a hold rating really tell us? It suggests that Wall Street sees a company that is incredibly good at one thing: making money and giving it back to shareholders. They love the financial discipline, they see the cash flow, but they are not fully buying into this grand story of a green transformation. They see a safe bet for predictable returns, not some revolutionary leader for the planet.
So we've looked at the courtroom, we've gone into the boardroom, and we've checked the pulse of the stock market. We've peeled back the layers of the official story to look at the financial code written underneath. And it all boils down to one final question.
So, is Shell executing a brilliant, practical transition to a new energy future smartly funded by its old business? Or is this all just an elaborate rebranding, a masterclass in corporate storytelling that puts shareholder value above everything else, while using the language of sustainability as the perfect cover? We've laid out the evidence. Now you decide.